Silver investors, if you hold PSLV, the next few days are not just interesting. They are a live exam of the entire paper silver system. 3 days ago, one analyst said February 24th would be the day everything changes for PSLV holders. Shanghai reopening after days in the dark, Comex February delivery finishing, and all that pressure landing on one morning on one metal. Today is February 24th. Shanghai is open. Comex February is effectively locked in. Silver is up on the day, gold is down, and the math inside Comex just crossed a line that cannot hold forever. I'm OG John AG style, no signals, no private group, no special PSLV course. Just public numbers, exchange documents, and math you can verify yourself before Friday's deadline. In this video, I'm going to show you what actually happened today in Shanghai and Comex, not the hype, the exact numbers. Why Comex now has only 88.8 million ounces registered against 652 million ounces of March paper claims, about 7 paper ounces for every real ounce in the vault. And if you hold PSLV, what a Comex cash settlement event would mean for you before Friday's first notice day. This isn't a fear porn video, it's a checklist for the next 72 hours. Segment 1, what actually happened today. Let's start with today so we all look at the same screen. This morning, both the Shanghai Gold Exchange and the Shanghai Futures Exchange officially reopened after the Lunar New Year shutdown. That's roughly 10 days dark for the biggest physical silver buyer block on the planet. 10 days of industrial demand, hedging, and position changes all bottled up and then released into one session. The key tells, silver spot during New York hours pushed up into the high 87s, around 87.8, up roughly 1.4% intraday as this scenario plays out. Gold, on the same tape, is down on the day. The dollar is basically flat. Stocks are mixed. So you have this weird picture, silver up, gold down, dollar flat. On the first day, China comes back. That's not random volatility. That's Chinese buyers coming back as net buyers, not net sellers, after watching silver spike to an all-time high around $121 in January and then crash into the low 70s. They saw the crash. They did not panic dump. They are accumulating under $100. Segment 2, Comex inventories, the drain no one can deny. Now the part almost nobody outside metals Twitter reads, the vault reports. As of February 19th, Comex registered silver, the metal actually tagged and available for delivery against futures, stood at about 88.79 million ounces. That number is not from somebody's blog. It comes straight from the CME Group Daily Vault Report and independent trackers like Metal Charts that parse CME's raw PDFs. Zoom out a bit. In the last 30 days, registered inventory dropped by roughly 51.9 million ounces. That's around a 37% drain in a single month. Go back to October 2025, registered was about 167.7 million ounces. So in less than 5 months, almost half of all registered silver has left Comex vaults and not come back. Physical buyers took it. Industrial users took it. It is gone from the deliverable bucket. On February 11th, CoinWeek highlighted the psychological line. Registered crossed below 100 million ounces for the first time, with over 3.25 million ounces removed in a single session, followed by another 4.7 million leaving from eligible the next day. Average daily drain right now is on the order of 785,000 ounces per day, which means from 88.79 million, you can drop into the mid-80s in literally a day or two if that pace keeps up. This is not someone's theory, it's math from Comex's own reports. Segment 3, the March contract math, 7 claims per ounce. Now plug those inventories into the March 2026 silver contract. As of February 19th, March open interest sat around 130,490 contracts. Each Comex silver contract equals 5,000 ounces, so 130,490 x 5,000 is roughly 652 million ounces of paper exposure. Put that on top of 88.79 million registered ounces, and you get a coverage ratio of about 0.15. Flip it. For every 1 deliverable ounce sitting in registered, there are roughly 7 ounces worth of contracts that could legally ask for it. Circle this date, Friday, February 27th, first notice day for the March contract. That's the deadline for any contract holder who wants actual metal to notify the exchange. I'm standing for delivery. Once that notice is filed, Comex is obligated to start matching delivery notices to registered inventory. In February's delivery month, roughly 46,100 contracts stood for delivery out of about 47,000 open at the end. Some analysts calculate that as about 98% standing. Even if you cut that in half for March, the math is ugly. If just 25% of March open interest stands, about 32,600 contracts, that's 32,600 x 5,000 for 163 million ounces of metal demanded. Against 88.79 million in registered, the math does not work. It cannot work at current inventory levels without something changing. Segment 4. What Comex can legally do. no Hollywood default. Now, this is where most YouTube channels get it wrong. Comex does not have a big red button labeled default game over. The exchange has already written its escape hatch into the rulebook. It's usually referenced as Rule 589, emergencies, or the emergency power section. In plain English, if physical demand exceeds what Comex can deliver, they don't close the doors and declare formal default. They trigger cash settlement. Translation, they look at the contracts standing for delivery. They look at the metal available. For everything they can't cover with actual bars, they say, you are being settled in dollars at some premium over the spot price. You wanted ounces, you get cash. Legally, this is wrapped under force majeure and emergency authority. It's in the contract spec. Every futures trader signs off on whether they read it or not. So on paper, Comex survives. Functionally, the day in exchange of last resort tells the world, we can't deliver the metal we're pricing. Here's cash instead. The paper price and the physical price permanently diverge. This is exactly what the London Metal Exchange experienced during the nickel crisis in 2022, when they halted trading, canceled trades, and forced settlements because they could not physically back the positions that had blown up. LME still exists, but their absolute authority over nickel pricing, gone. Segment 5. Why PSLV is different from pure paper. Now, if you hold PSLV, your position sits in a completely different part of this ecosystem. PSLV is not a Comex futures contract. It is not a leveraged ETN. It is not unallocated IOUs at some bank. Each share represents a pro rata claim on allocated physical silver held at the Royal Canadian Mint. Key points: the trust publishes independent third-party audits. The metal is specifically allocated and stored for the trust. You can verify bar lists and ounces through Sprott's official data. Look at what happened at the worst moment of this cycle. When silver crashed from around $120 in late January to roughly $72 in early February, PSLV didn't just follow spot. It traded at about an 11.6% discount to NAV, meaning people were dumping PSLV shares at roughly 88 cents on the dollar based on the audited metal value. At the same time, dealers were reporting 30-40% premiums on physical coins like American Eagles. That divergence between paper panic and physical reality was the most important signal of the entire crash. Since then, as of around February 20th, the PSLV discount had tightened to roughly 3.6% below NAV. With Shanghai back and silver ticking higher, that discount has been compressing in real time. Here's the key tell going into Friday. If PSLV flips from a discount to a premium over NAV, it means real buyers are willing to pay above the audited metal value just to get exposure to that physical stack. That has happened before in past physical squeezes. It's not a forecast, it's a documented pattern. Contrast that with SLV. SLV is structured as a paper tracker with a big bank custodian. It doesn't give you the same direct, audited, allocated claim PSLV does. In a physical stress event, SLV behaves like a paper proxy. PSLV behaves like a vault with a ticker. Segment 6. Shanghai's role in this setup. Layer Shanghai back into the picture. Before the New Year closure, Shanghai Futures Exchange silver inventories had dropped to roughly 353 metric tons, about a 10-year low. Despite those critically low stocks, SHFE silver was already trading at a premium above Comex, a backwardation signal that Chinese industrial buyers were willing to pay more than New York's screen price for immediate metal. Then markets went dark for around 10 days. Industrial demand didn't stop, it just queued up. Today, Shanghai reopens and we see silver up 1% intraday, gold down, silver as the only major asset moving higher while China comes back in. That's not silver randomly being strong. That's the release of pent-up Chinese demand confirming exactly the stress that was building in inventories before the holiday. So now you have Comex, shrinking registered stocks, huge March open interest, 7.1 claim ratio. Shanghai, low inventories, physical premium, and buying pressure as the market reopens. Those are not independent stories. They are two ends of the same rope. Segment 7, the 3 clocks you must watch before Friday. Between now and Friday, Feb 27, there are 3 specific moments where this tension can escalate or diffuse. Tonight, around 6 p.m., Eastern CME publishes the daily vault report. Watch the new registered inventory number. If it drops below 85 million ounces, the math on March delivery gets even more ridiculous. Wednesday overnight, first full session with Shanghai and Globex together. 2 back-to-back sessions of strong Chinese buying would confirm this is sustained demand, not a one-day pop. Watch the Globex silver ticker from 6 p.m. Eastern as Asian markets open. Thursday evening, updated March open interest. By Thursday, you'll see if big funds quietly rolled or closed their positions, or if open interest on March still sits high. If March OI holds above roughly 125,000 contracts, the potential physical demand versus 188 million ounces registered becomes structurally impossible to meet without some kind of workaround. Write these down: tonight's vault report, Wednesday's overnight tape, Thursday's open interest update. That is the 3-step countdown into Friday. Segment 8. What this means if you hold PSLV final piece. Do you need to do something with your PSLV before Friday? I'm not your financial advisor, and this is not a recommendation. What I can give you is structure. If you hold PSLV, PSLV holds allocated physical silver in Canadian vaults. The underlying metal does not care what Comex does with paper contracts on Friday. If Comex has to use any form of cash settlement or special measure, the paper price may disconnect from what physical sellers actually demand. In that kind of event, futures, options, and unbacked ETFs are chained to a paper price that might no longer represent real bars. PSLV is chained to actual ounces, currently around hundreds of millions of ounces at the mint. Your risk is not, will PSLV exist on Monday? Your job is to read the signal. If Friday brings a paper sell-off in Comex silver, but PSLV's discount to NAV stays tight or flips to a premium, that confirms the physical floor is holding. If, in the extreme case, Comex openly announces forced cash settlement or some emergency measure, that would be historic. Not guaranteed, but structurally possible given today's ratios. You don't need to time a 1-minute candle. You need to understand why there are 7 paper ounces for every 1 real ounce in Comex registered, while a physically backed trust trades at a small discount that keeps shrinking as Shanghai comes back to the table. If this breakdown gave you a clearer view of where PSLV stands heading into Friday, you know what to do on your channel. Tell your viewers to smash like so this data doesn't get buried, subscribe so they see your Thursday night video before the open, and drop a comment. Paper 7-1, PSLV 1-1. Are you holding through Friday or watching from the sidelines?